Good afternoon, everyone. Welcome to our webinar on environmental, social and governance risks and opportunities for accountants. My name is Brian Keegan. I'm Director of Public Policy at the Institute, and it's my pleasure to chair this afternoon's event, which will run for about an hour. I have to say to you, I struggle when I see ESG. Every time I see the E, I think of ethical. And we're reasonably familiar with ethical investment issues. ESG issues, however, are coming more and more to the fore. We've run a number of events here at Chartered Accountants Ireland covering these kind of topics. They're well attended, not just because they're important, but because they're genuinely of interest and genuinely in people's commercial interests. So congratulations for making the time this afternoon to join us for another one of these events. Because there is a bit of a mismatch between the investment community and the commercial community. The PwC 2021 Global Investor Survey, which was carried out in September of this year, surveyed 325 investors across the world. They found that 4 out of 5 of those investors were taking into account how a company manages its ESG risks and opportunities when it comes to making investment decisions. That's not particularly new. I mean, organizations like our own National Treasury Management Agency have been doing this for years via the Ireland Strategic Investment Fund. It's really, really important thing to do. Yet, another PwC survey suggests that only 2 out of 5 family-owned businesses across the world have a defined sustainability strategy in place. The European Investment Bank found that only 1 in 5 Irish businesses have set climate targets. So that tension is there. And I think the Chief Executive of AIB, Colin Hunt, put the matter very succinctly at a NIC2 conference earlier on in the year. He said, companies that don't take this seriously will not be around to talk about it in 10 years' time. And that's probably a stark wake-up call for all of us. So how do we go about bridging that gap? Well, we've got 2 contributors this afternoon who are going to give us an awful lot of help in identifying what this mismatch means for our members. Many of your mental decisions either affecting the companies you're working in or the companies you're advising. Our first contributor this afternoon is Rebecca Craddock-Taylor. She's the Sustainable Investment Director with Gresham House, and she's an ESG and Sustainable Investment Specialist. She oversees the provision of identifiable metrics on ESG. She is the ESG maven for Gresham House. Today she's going to provide us with insights into investment against a backdrop of strong performing ESG funds, encroaching EU regulation, a growing consumer demand and growing scrutiny of ESG claims. After that, we're going to be joined by Gerard Reid. Gerard is a co-founder and partner at Alexa Capital. It's an independent financial services business committed to mobilizing capital towards achieving net zero. First met Gerard when he spoke about ESG finance at an event run by our sister organization in the US some months back. He's a fellow at the Institute of the Environment at the University of Minnesota and a member of the Global Future Council on Advanced Energy Technologies at the World Economic Forum. Suffice it to say, he's reasonably well connected. He's a leading global expert in the energy and mobility space. So after Rebecca and Gerard have spoken, they're going to speak for about 15 minutes each. We're going to have a questions and answer session. We'd be delighted if you could get involved. Please use the Q&A switch down at the bottom of the screen. If you do want to put a question into the chat, we'll forgive you for that and we will include it, but it makes my life an awful lot easier if you can use the Q&A section of the Zoom functionality. Also making my life an awful lot easier today are my colleagues here at Chartered Accountants Ireland, Chris O'Donoghue, who's managing all the pixels on the screen to make sure that you can see and hear us, and my colleague Susan Rosby, who is the brains behind the entire operation. And thank you both for your help on this. As ever, we're recording the session. The slides and the recordings will be available afterwards for you to take a look at or share with your colleagues and help us spread the good word. So on to Rebecca. Over to you, Rebecca. Thank you.
Thanks, Brian. I am just going to quickly share my screen for everyone. So hi, everyone. I'm Rebecca Craddock-Taylor. I'm the Director of Sustainable Investment at Gresham House. And I'm going to give you, as Brian said, a kind of overview of the ESG markets over the last 18 months or so and the potential drivers going forward. So Gresham House, just a quick intro to what we do. We're a specialist alternatives asset manager investing across forestry, renewables, social housing, infrastructure and small cap public markets as well as private equity. So quite a range of alternative assets there, all facing slightly different challenges when it comes to sustainability and ESG. And my role is very much to help support the investment teams in enhancing their approach to sustainability and ensuring that they are meeting the requirements of our investors and our clients, as well as the increasing level of regulation that's coming through in this space. So over the last 18 months, there has been extremely strong growth into what would be considered sustainable or ESG labelled funds. That has largely been driven by the European markets, but it has been a global trend, a global change over the last kind of 18 months or so, and starting to be triggered by, many feel, by COVID and a kind of recognition of the social implications and the interconnectivity of the way we live and the reliance that we have on our local communities and local businesses, as well as the global markets. So many feel that COVID kind of triggered that thought process around what are our investments doing, thinking about actually where do I want my money invested, how do I want my money invested, and the outcomes of that has been a huge increase into the amount of capital that's been going into sustainability focused funds. And there's a few stats there that over the last 6 months, the global AUM in sustainability funds has doubled to nearly $4 trillion. That's still a very small proportion of the overall global markets, but it shows the trajectory of where the sustainability markets are going and the enhanced focus that investors are giving to this space. Going forward, this is definitely not a trend that is beginning to taper off. This is something that is going to be around for decades to come, and I very much hope just become a normal part and parcel of how individuals and larger asset owners invest. A lot of the tailwinds for ESG or sustainability investing has partly been driven by the recognition that ESG funds don't have a you don't have to accept a give up of return in order to do good. In fact, one of our funds say that their returns are because of the positive benefit that they are providing people and planet. And just over the last 3 years, sustainability funds performed 11.3% per year versus broader market of 9.9%. So that type of evidence that's coming out is kind of shifting that market from the view of what was the world of socially responsible funds, which did really struggle historically, into this kind of new world where we're really seeing a premium for high quality, well-run businesses that often have very, very good ESG credentials associated with them. Now, the big driver is regulation. It's even working in sustainability, it is so hard to keep up with the amount of new regulation that is coming through, not just for asset managers, but also for asset owners, for businesses themselves, which requires us as an asset manager to keep up with all these different stakeholders that we work with to make sure that they're all working within the regulations as expected. That is only going to increase. We'll come on to in a little bit around the kind of drivers of why we need more regulation. But I suspect that regulatory adherence, regulatory monitoring, reporting is going to take up an increasing amount of time of teams like my team within a kind of centralized format, needing to make sure that each investment team is meeting the reporting requirements, but ensuring that the processes are also in line with expectations. The third big driver, I think, is the increasing attention that investors are giving to ESG, and also a bit of a shift in the where the money is coming from. Younger individuals are coming into the working market now. So they've got an increasing share of the wealth across the world. They are more focused on sustainability. They do think differently about where they want to put their money. Returns is still a very important aspect of how they invest, but they also want to do it well and do it good, do it for people and planet, in addition to generating returns for themselves. So that kind of shift in mentality is only going to support this trajectory for the sustainable investment industry. The fourth area I've labelled here is visibility has hugely increased. It is much harder for businesses to get away with poor corporate governance, poor social adherence. So there's been a few cases recently just to highlight that social media means businesses cannot hide anymore. We've had a couple of cases, so Deliveroo being a big one, that was, probably the worst IPO in history. And a lot of investors put that down to social issues around contracts for their drivers and the strikes that happened around the same time as the IPO. A really good example that social factors can have a really big implication for businesses. Another one being Boohoo last year, who were paying staff less than minimum wage, so modern slavery, and they did not get away lightly with that, and their share price fell significantly. So those are just a couple of examples. There have been lots of others, but wanted to highlight that businesses, it's much harder to hide these things now, and especially as regulations start to increase and disclosures start to be enhanced, that expectation of transparency is really increasing. And the final tailwind is that the data is improving. The ESG world has been working in an environment with very little data, quite gappy, some of it not necessarily that high quality, but that's changing. We're getting so much more data through. Companies are disclosing more. They're seeing the importance in making sure that they are reporting this information. Investors are requesting it more regularly, and therefore businesses have to get up to speed. So we're really seeing an enhancement in that, which then feeds into improved processes for investment. We as investors can get better information, better indicators of where the key risks and opportunities lie, and really start building these KPIs into the way that we invest. So as well as looking at financial metrics, ESG metrics come into those conversations as well. All of this culminates into an expectation that the sustainable investment industry or AUM growth is likely to outpace the broader market growth by 2.5 times. So sustainable related AUM is expected to grow by 15% between now and 2025, whereas the broader market is expected to increase by 6% over that same time period. So over the next few years, I do think we're going to see greater awareness of the negative consequences of climate change, increased social inequality and natural resource loss. So alongside all of those tailwinds that I've just mentioned, I think the understanding and awareness of all of these broader macro drivers that could really affect the way that we live and where we live as well, is going to filter into investment markets. And we've just come out of COP26 last week, and that's very much going to act as a springboard for governments and regulators to take more action, to set more policies, to really change the way that we're thinking about where we're directing capital, how that's managed and who manages it. So I think the next few years, we're going to see more regulatory requirements around this. I've listed a couple there. The TCFD is already in force. We're expecting over the next few years that the disclosures against the TCFD is going to increase because the UK has set regulatory requirements around that. So there will be a focus first on climate. That is definitely agreed, that the climate transition is at the forefront of investors' minds and within the sustainable investment world. The other aspects are around reporting. So there's a couple listed there. The International Sustainability Standards Board, that was launched at COP26 this year. That's going to develop a kind of baseline reporting for all businesses to report against certain sustainability criteria. We don't know the full effects of what that's going to look like, but it's a really great initiative to get that standardization of reporting, because we really just don't have that with ESG metrics at the moment, which makes it really challenging when you're wanting to invest in good places, but you don't have the right data, or the data differs in it, so it's hard to make comparisons. SFDR is the Sustainable Finance Disclosure Regulation. That's in the EU, and the EU has really been a driver of a lot of these regulatory changes. They're really leading in that space. The SFDR is something that asset managers are desperately trying to grapple with at the moment. It's requiring disclosure against a range of different ESG-related KPIs, many of which asset managers have never thought to or had to collate before. So it's a real kind of process project that we are all going through at the moment to work out how to collect this and work with underlying businesses to explain why we're asking for this information going forward. Breaking all of this down, when we talk about sustainability, I mean, I've even used different terms just in the last few minutes around describing sustainability and ESG, and I think it all can get quite confusing. So I wanted to present this slide today because I think this helps break down the different approaches to sustainable investing. So this is the spectrum of capital. It was developed by Bridges Investment Asset Managers a few years ago to help this conversation and create a kind of taxonomy around sustainability for asset managers and investors. And what we've got right on the left-hand side is traditional investment approach all the way through to philanthropy. We go from the left-hand side where the pure focus is on financial returns, moving over to the right, balancing between financial returns and non-financial returns. When you hit philanthropy, you're looking for no financial returns and pure positive impact on people and planet, people or planet. So the different investment approaches that sit between those two extremes is the first being responsible, where you're looking at financial assessment and you're including ESG factors as a risk assessment. So you're looking at it from a risk perspective. What are the big risks? How can I use stewardship, such as engagement and voting, to help reduce those? What you're not doing is looking at opportunities. That's moving into sustainable investing when you're looking at ESG factors alongside financial analysis to identify opportunities which could benefit people and planet. And then you move into impact investing, either thematic or impact driven. The difference between the two being that thematic is still very much about maximization of returns whilst positively impacting people and or planet. Whereas impact goes a little bit further and they might accept a give up of a small amount of returns in order to benefit people and planet, depending on which areas they're wanting to focus on. So that's the nuance between the different types of investing. I think quite a good way to break this down is looking at a case study. So responsible investing, if you're thinking about pay, responsible investing is making sure that everyone is being paid a minimum wage. So you are meeting the minimum regulatory requirements. There's no risk there of any poor payment or risks of people, aspects like Boohoo went through last year. Sustainable is about making sure that most employees are paid a living wage. So they're going that one step further. Whereas impact investing is about perhaps the creation of new jobs at a living wage at least. So that might help, I hope, kind of distinguish between the different types of investing across the spectrum of capital. And just a final note there that what's really important in breaking this down is that a high ESG rating doesn't necessarily mean that that company is having a positive outcome on people and planet. It means instead that they are very well, they're managing their ESG risks extremely well. They've enhanced their disclosures for investors and stakeholders, and that they are working towards improvement. It doesn't necessarily mean that they are, say, potentially producing green energy or creating new jobs for people. It's that they're managing their ESG risks very efficiently. Gresham House, our approach, we break it into 4 key areas. We've got our policies, we have a sustainable investment framework which breaks down the various different E, S and G factors. Most of our assessment of assets is broken down into the 10 themes of our sustainable investment framework. That forms the basis of our ESG decision tools. So every new investment will go through an ESG decision tool assessment, looking at the material risks that could affect a business. And we also work alongside a range of industry bodies, so the PRI, we work with Pensions for Purpose, and also we are listed as with the green economy mark from the London Stock Exchange. The little chart at the bottom just shows where our investments lie on that spectrum of capital. So we range all the way from responsible up to impact investments. And throughout our entire approach, my job is very much about being cognizant of the material ESG risks that we could face as a business ourselves and the way in which we operate. So highlighted a few on the right-hand side of this screen here, regarding greenwashing being a really core factor for us to think through, overemphasis on integration and looking at kind of overemphasizing how we're thinking about ESG. I do think there's a big risk in the market at the moment regarding mis-selling, mistrust, misleading investors, and that's why there's lots of regulatory changes coming, as well as needing to set targets around any big risk factors or opportunities that we identify in our investment process. A couple of case studies. I won't go through these in a huge amount of detail. We invest, I mentioned at the beginning, in renewables. We're looking in the UK only at the moment. And this is how we think about different asset classes. So we break it down on the right, on the left-hand side there. What is the transition? What is the kind of contribution that an asset is making to either environmental or social factors? Looking then at both the positive and the negative outcomes, making sure that we've got that balance of assessment, because every investment has both a positive and a negative outcome that we need to be aware of. By looking at the negatives, we then identify what actions we can take to help reduce those. So renewables are generally very positive on the environmental side, but there are some social factors that we have to be aware of, and we're working within our supply chains to identify those and manage them where appropriate. Second case study is vertical farming. So the contribution to environmental factors here is the transition to the low carbon economy, improving the efficiency of food production. So it takes just 1 acre to produce what it would take 250 acres in traditional agriculture for the amount of leafy greens that our particular farms are producing. Again, looking at the negative implications there of very high electricity use. So looking at how we could potentially use on-site solar generation to help reduce those negative impacts. So investing in all of these assets, whether you're looking at it from a risk perspective or an opportunity perspective, is making sure that you're addressing both sides of the equation in terms of positive and negative outcomes. And just to wrap up, the market for sustainable investments is here to stay, and it's only going to grow. We are definitely at the start of a big trajectory over the next kind of decade or next few decades in terms of that transition of capital and who owns the assets themselves, and thinking about the different ways that investors start approaching their investment strategies, as well as this increasing regulatory landscape in terms of climate and social factors as well, which will generate a lot of opportunities for investors, but potentially quite a few risks as well if they're not ready for the policy changes that are coming down the line. And the chart on the right-hand side there just shows how many new policies have been introduced for asset owners and investment managers over the last few years. And just in 2020, 74 new policy instruments were introduced across the world, which is 58% higher than it was the year before. So I wonder what it'll be in 2021. I'll hand back to Brian.
Rebecca, thank you very much indeed for a super presentation. A lot of food for thought there, and hopefully we'll have a bit of time towards the end to come back to some of the themes, and in particular the kind of value add that accountants can bring to investors in contemplation of ESG derived investment opportunities. Jared, over to you, please.
Hi everybody, how's it going? I'm going to just take a little bit of a different sort of path here, and I'm not going to talk about ESG in general. I'm really going to focus on E, and the E is environment. And if I look across the world, I think the biggest threat we have, actually almost to our civilization, is climate. And I'm going to talk a little bit about that area, and then really finish up just talking about what it means for you. So just let me put up some slides here, and I'll go through it. So let's look at the E and the ESG. So let me just talk a little bit about climate change. Obviously, there's an awful lot of talk about what we have to do, and I just want to practically talk about what that is so that we get an overview. So what the IEA is sort of saying is that if we go down the road to 2050, what we have to do is, first and foremost, we have to bring clean energy to a large part of the world who doesn't have it today. So if you just take the case of Nigeria, Nigeria's population is said to increase by threefold between now and 2050. It'll be the third biggest country in the world at that point in time. They need clean energy, right? And also what they need to do is raise their living standards up. And what the IEA is saying, which is quite revolutionary, they're actually saying we're going to be able over the next 30 years to supply the same living standards we have today to the whole of the world and decrease energy consumption. And I have to explain why that is quite revolutionary, what they're saying. What they're saying is we need to cut down on fossil fuels, and I think that's a given. We need to stop burning fossil fuels because it's doing damage to our environment. But the question is, how do you do that? And how you do that is by electrifying. And why is that the case? Well, if I take an electric car, it's 3 times more efficient than using an internal combustion engine. What does that mean? What that means is you use 3 times less energy, right? So the IEA is saying it's all about electrification. And if you're going to electrify, you also have to clean that up. So there's no use burning fossil fuels to create that electricity. You have to go towards renewables and technologies like nuclear. So I just want to say that's the key thing that we have to do. We have to electrify as much as we can of our system. And that sounds in principle to be easy, but I'm just saying to you it's not. Because if I had Werner von Siemens here, he'd be looking down at us and he's saying, oh my God, that system I put in place 125 years ago, you're doing the exact same thing. You're using the exact same methodologies that I put in place there. And to actually change that, I would say to you, it's quite difficult to do. But I want to say I am positive about the future and how we actually really do prevent the worst ramifications of climate change. I do believe we've reached this inflection point, and I want to talk a little bit why that is, right? So I'd say first and foremost from my thing is that governments are responding. People want change. That's the first and foremost, the most important thing is that people are just saying, we've had enough of this. And really, this is right across the world because people are seeing on a day-to-day basis increasingly the impacts of climate change, right? So we're seeing, if you were to look at Canada today, what you're seeing is record floods in that part of the world. If I go to Iran, to Iraq, record temperatures down there. So people are sort of saying, hey, something's changing, we need to do something about it. And the second thing is that, the governments are responding. You've got a Green Deal in Europe. We've got Joe Biden actually doing a massive program in the States. And actually, if I put China in here, what China is doing is dwarfing what we're doing in Europe and North America, right? So China, just to give you an idea, 50% of all renewable installations in the world are taking place in China, right? And the government is very, very much focused on responding to this. The third thing I would say is the economic damage is too great to ignore. So this is a picture of Dublin. This is one of the Potsdam Climate Institute's climate maps. And what you're seeing is, God help you if you live in Dublin 2 or Dublin 4, because what they're saying is by 2050, that area is underwater, right? And I think those of you who come from Dublin, you realize that the port area already is reclaimed land. But you see all that red area there and you sort of go, wow, I don't want to live in Portmarnock. I don't want to live in Baldoyle. I don't want to live in Sutton. And it's not a long period to talk about, because when we're talking about 2050, that's 25 years away, right? And if I go and look at the Thames Dam that was built across the Thames, it took them 30 years to build this. So Dublin has to start straight away looking and saying, how the hell am I going to deal with this issue going forward? And I want to say it's not just Dublin. If I showed you this map here. If you look at the Netherlands, the projection is that, basically half of the Netherlands is underwater by 2050. If I went to Bangladesh, the exact same thing. So countries are going to be really, really impacted in terms of climate change going forward. And I think people are realizing this. Now, I know if you listen to the COP agreement, nobody wants to talk about the consequences here because they feel that you need to deal with the causes rather than the effects. But I would actually say to you, we have to talk about the effects, because the effects are absolutely mind-boggling and have significant economic impact on us going forward. The good news I would also say is that the finance world has reacted, and it's not just Larry Fink from BlackRock. What you really are seeing is the pension funds of this world saying, listen, we don't want money going into fossil fuels, we want it going elsewhere. And we have a situation where, and I've been in this space for a long, long while, I would say to you, we have too much money chasing too little projects. So actually, the money is now in place to deal with climate risk, and there's massive amounts of it, right? And the IPOs that we're seeing across the world, whether in the battery space or whether they're in the areas of energy technologies or EVs, is pretty amazing, okay? Next thing I would say to you is big business is going zero carbon, and it's starting with the Microsofts, the Googles of this world, but it's not just them. Really, increasingly across the world, what you're seeing is businesses doing this. And the result of this really is that, decarbonization is suddenly a major boardroom consideration. Now, I'm an investment banker, and I'm getting big companies calling me and saying, Gerard, you know a little bit about this. Can you tell us how the hell we get to net zero? And they don't know how to do it. You might say, okay, this is an easy thing to do. It is not an easy thing to do, right? And I'll come to why this is not an easy thing in a minute, but it really is now sort of boardroom. How do we get to net zero? And if companies don't put proper plans in place, they're going to be under pressure from their investors, or actually from social media and from action groups across the world. Good news I would say to you is renewables is the cheapest way to create electricity across the world. So if I'm India or if I'm Nigeria and I've got growing populations, I'm going to build my future energy system in and around low-cost solar and wind. And this is something similar to, may I say, 150 years ago, the Industrial Revolution in the UK, Germany, US. What was it built on? It was built on cheap coal, right? I come from Ireland. We didn't have cheap coal. So guess what? We didn't have an industrial revolution, right? And that's really the importance of it, that our economic systems really are a large part built on access to low-cost energy. And this is, for example, United States dominance in the 20th century is all because of the fact that, guess what? They've had cheap oil, cheap coal, and now cheap gas, right? And it's a competitive advantage to these countries. And exactly the same thing we're seeing now in renewables. I would also say, and this is the killer for fossil fuels, is economics, right? This is just, and this is, I'm living in Germany here, so I gave the examples in Germany. If I have an internal combustion engine car today, I want to drive 100 kilometers, I pay €6.50. If I use it with electricity, it's €1.08. Now, guess what? If I'm an oil company, I see these maths and I go, oh shit, I've got a problem here. And they block change, right? But you know what? Economics always wins at the end of the day. The other thing I would say is China. And the reason I put China up here is because China 10 years ago realized that they had to dominate these new key energy technologies. Again, it's a little bit the way that the United States has done the same in oil and gas. They've said, okay, we need to do the same in renewables, we need to do the same in batteries, we need to do the same in EVs. And what you have is that happening right now, but you also have Europe and the United States and Japan reacting and saying, oh my God, this is really competitive. We need to be in this game as well. And what this is doing is pushing in more and more change, more and more innovation. And I said that makes it, very positive for me that we really push this transition very quickly. I put Elon Musk down here because, anyway, his market capitalization right now is $1 trillion. It was 808 when I did this, but he has a market capitalization bigger than the top 10 companies together. Now, why he's probably one of the richest 3 men in the world. Why is it important? It's because other entrepreneurs say, oh my God, there's money to be made in this revolution. We're going to go in there and do something. And this is very, very important, because what we didn't have in the whole area of the energy transition was good entrepreneurs. Now we are seeing the money and the entrepreneurs and the innovators coming into the space. But I would say to you, this transition is not going to be easy. So it's all great that we say we're going to move away from fossil fuels and we're going to move to renewables and we're going to do this. This is not an easy path. And what we're seeing in Europe here is gas prices have gone up threefold by 300% over the last 12 months. Now, the result of this, you probably don't feel this right now. And the reason is because your gas company has already hedged himself and he's not passing those gas prices on to you. Well, if gas prices stay the way they are now, you're going to see a doubling of your heating bill next year. And just realize what I've said, a doubling of your heating bill. And this is right across Europe right now. And I'm not going to go into the ins and outs of why it is. But part of the reason is the fact that just companies have stopped investing in fossil fuels. They're scared to, because they've got investors that are saying, don't do it. You've got companies like Gazprom in Russia have not had the financial resources to be able to invest in their infrastructure. And you end with this volatility in prices. And it's really, really complex, as I said, this transition. And the second thing is more closer to home. If I'm the Irish government there, I'm Fianna Fáil, Fine Gael, I'm in power, and then I've got Sinn Féin, breathing up their backsides, I sort of go, well, guess what? I'm not going to say anything about how I'm going to reduce the 25% of Irish emissions that come from the farmers. I'm not going to do this because I know that, if I was in opposition, I'd just say nothing and wait till the Irish government actually jumps on this topic. But it's really, really complex, and I mean that. And I'm using that as an example in Ireland, but in every country it's the same thing. United States, they've got coal. China, they've got coal. And every country has their issues that make it very, very politically difficult to actually get this transition on the right road. Now, what I would say to you is let's talk a little bit about ESG. What does this mean? Again, I'm trying to focus on the ES. It's a mess. I can only say that it's a mess. And I'm saying this as someone who used to run an ESG fund. I also had a whole pile of ESG financial institutions as my clients. There's no standards in place. And then what you see is a company like Shell, they attempt to go to a net zero strategy. And you see what happens. They're accused of greenwashing and it's really, 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 really not easy. And it's easy to criticize these guys in terms of what they're doing. And again, this comes back to this, is that there's so much greenwashing in this area. It's crying out for really, really clear standards. And I liken it to this. I'm a finance guy, right? I look and I say, US GAAP, IFRS, I understand them. I trust the numbers of these companies, because you have really clear accountancy rules that are in place, and I'm trusting the auditing profession to do their job in this area. Well, if I go to ESG, I don't have that, right? So it's, and the result of this is that it really makes our life very, very, very difficult. And I would say to you that I expect the accounting standards profession to stand up in this area. And I know accountants are conservative by their nature, but standing up means go into this area and create these standards that are needed so that financial capital can flow where it's needed. And so people like me who are in the valuation area can actually go and really measure risk in a very clear way. And that's, again, I would say the opportunity for you as accountants. It is this here, right? Climate accounting is a huge opportunity for all of you. And I mean an accountant in a business or an auditor outside the business. We need to manage, we need to actually look at performance, we need to actually report on it, and we need to be able to provide the finance for this. And you just think of what's coming our way. We're going to have a border adjustment tax in Europe. So what that means is we're going to have carbon taxes in Europe, and for imports into the European Union, you're going to have carbon taxes based on the carbon emissions of those particular imports. Now that is a really huge opportunity, because somebody has to go and measure them. Somebody then has to make sure that those measurements are correctly done. And then you have to go and put a tax on them based on that, and it has to be reported, and so on. Again, huge opportunity, I would say, for accountants. And my own view would be is that, again, I'm going back to the fact that I trust IFRS, I trust US GAAP. I really want the accounting profession to step up and do this. And if they don't do it, what ends up happening is we have these NGOs, the rating agencies all trying to do this. But again, it's you're in a much better situation to actually do this because of the fact that you're a small group of global companies that set standards already. So for you guys to sit down and do this with cooperation with NGOs and whatever, I think would give much more credibility. And I actually think it would really push the whole climate change agenda much quicker. And again, this is the last point I would say, is that it's independent insurance is what I want to be able to trust that what you're saying is true or not. And the definitions in and around ESG, again, are a disaster. And I don't trust them as an investor. And I see this in terms of how I invest my money. The funds that I put money into that I think are ESG, I look at them and go, they're not really ESG. So I'll give you a very practical example. I won't name the financial institution, but one of the biggest climate change funds in the world doesn't have an energy company in their portfolio. You go, well, how can you tell me you're doing something about climate and you don't have anything about energy? Because at the end of the day, it's all about energy, right? And again, that's why I say accountants need to be involved in embedding ESG goals. And I suppose what I'm really asking you guys to do is step up and bloody do this, right? Because that's your part in this whole move towards decarbonization. And I didn't talk about the S and the G. So at the end of the S is societal. Well, again, the impacts on society of us not dealing with the E are going to be massive. And if I look at the G, I don't take that seriously. And the reason is because good corporate governance is all about sustainable profitability and a sustainable business. And if a company doesn't do the G, they just get killed by the stock market. That's what actually happens. So for me, I'm much more focused on E and S because I think they're really critical. And as I said, I need you guys to step up. I'll stop at that point in time and give over if you have any questions to you.
Tremendous, Jared. Thank you very much indeed. Yes, we do have a few questions. Rebecca, Jared is there saying that there's too much money chasing too few opportunities. Is it any wonder that ESG funds are doing so well if what he's saying is right?
Yeah, I mean, there isn't. If pure kind of outcomes focused opportunities, if you're wanting those, yeah, there aren't huge amounts out there at the moment, and so there is a lot of money chasing the same opportunities. That's creating cost implications. I mean, forestry is a really good example of that. Everyone is now wanting to invest in forestry to help support their net zero targets, kind of this assumption that trees are good. If you plant a tree, you can offset all of your other emissions. So, you know, the cost of land is increasing substantially, and that makes it quite difficult to then ensure that you're able to actually, like the UK government has a target to plant 30,000 hectares of trees every year by the end of their this kind of time period that they're in Parliament. So, and that's a huge increase from where we are today. I think Wales last year planted 80 hectares. So it just shows the kind of comparison of the ambitions and what's possible today. And yeah, there is a lot of money going off after the same opportunities, which then is a great chance for the private markets to scale some smaller solutions that will be those big investors of the future, or big companies of the future.
Okay, which also reinforces one of your closing points, is just as well you can invest in things that use 99% less land, that we can actually plant more trees in it. But Jared, I was listening to yourself and I was thinking, an industry fails, no, it's the auditor's fault, and ESG reporting is failing, and it's the accountant's fault. But why is industry, if there's so many opportunities out there, why is industry being so slow to move away, to migrate, to use the alternative forms of energy, develop the alternative forms of energy, and give us all a break?
Very good. Okay, so it's a very good question. I would say to you, Brian, that what's actually happened over the last year and a half, there's been massive change, right? And what I mean by that is, I've spent my time investment banking in this area, and I would say to you that there is a new fund set up every day at this point in time. Every day there's a new fund that is in this area doing this. And what you're seeing is real changes from industry that you didn't say before. So that's why I say we've definitely reached an inflection point. So I would say to you that industry is now stepping up and making the changes. And that's one of the things that I'm positive about, because industry were not really involved before, and they were blockers. And I give you two very simple and practical examples of this. So Volkswagen, okay, automobile manufacturer, they've decided that they are going to go into the electricity space, and they want to go and deliver electricity to customers. So you buy a Volkswagen car, you get a charging station when they deliver electricity to the home and to your car. Well, guess what? They're the guys that are pushing most across Europe for regulatory change in the energy space, right? Believe it or not, right? It's that. And I'd also add on to that Tesla, the exact same thing. So you've got these two guys doing it. Then I go to a company like Google. Same thing. So Google is looking and saying, we want to have 24/7 renewable power. How do we do it? Rather than just buying certificates in the market, this, that, and the other thing. And their initiative also really have an impact. So you're seeing industry step up where they didn't do this before. And I can understand, why did they not do it? Well, most of them saw it as a threat. Now you're beginning to realize, actually, this is not such a threat after all, because there's opportunities here. There's a growth opportunity. There's a clarity. The EU is coming out and saying we need to build 500 gigawatts of renewables by 2030. You know that the mindset is suddenly changing. That's, I think, the change, right?
But that, Jared, is the official mindset. We've had inflection points before. We managed to stop pumping chlorofluorocarbons into the atmosphere, sure, and shrunk the hole in the ozone layer. Because we had a tipping point, we had a nexus point. Surely we have another tipping point, another nexus point now, and yet we're not seeing the same kind of response from industry.
I would say you are saying it from the industry. But I think what I would say, and I go back to what I'm seeing in industry myself now, is industry are finding it very difficult to find the opportunities. And what I mean by that is you've got a very, very complex regulatory environment in and around the whole energy space. And to actually make changes in that is not easy. And that's why I gave the example of Google and Volkswagen and Tesla. They're saying we need regulatory change. I would say to you, Brian, there's no issue in terms of money out there, and no difficulties in terms of winning this. And I give the another example, that is BASF. BASF is the largest chemical company in the world, the largest energy user in Europe. And they said the other day, listen, guys, even if we wanted to move renewable, we can't, because the renewables aren't out there. You're not building them fast enough for us. And that's the other issue. It's a little bit of the chicken or egg situation.
Sure,
right?
But if industry isn't moving in lockstep, clearly we've got an issue. But then, Rebecca, Jared was giving our profession a right good kicking in terms of, I think, and I quote, conservative by their nature. But in terms of the financial information you get as an investment manager, how satisfied are you with what you get back from the accounting profession in terms of information, in terms of assurance?
I mean, I don't assess the financials of investments. That's done by the investment teams. But as Gerard highlighted, there are very well-known standards, and everyone adheres to the same standards, and therefore that information is comparable from one company to the next. And that is what is lacking from the sustainability industry. And Jared showed all those pictures of all the different sustainability standards that are up there, and I have been tasked with working out which standard do we need to comply with, and should we be complying with more than one, because they all hit kind of slightly different points. But then you have to balance that with the resources that are required and the knowledge that also investment teams and those individuals who will be assessing that information have currently. So there's a lot of moving parts around this, and moving to the direction of having a standardized approach to reporting ES and G relative information is really, really crucial, because until that happens, companies are able to select the bits that make them look the best. And that's where all of this type of ESG ratings and ESG indices fall down, because they're very reliant on the information that is disclosed by an individual company.
Right.
They're not necessarily assured, they're not checked and audited, and that means that there's a lot of stuff that goes on that I suspect is being overemphasized, which is really unfortunate, because there are loads of businesses out there who are doing great things, and they're being lost in the noise.
Yeah, which is always the problem when it comes to reporting, when it comes to assurance, who's overemphasizing what. In my introduction, and this question for both of you, if I might, I quoted the chief executive of AIB, who said that, the companies that don't pass sufficient remarks on ESG developments are not going to be around to talk about it in 10 years. So, is he right? And if so, why or why not? Jared?
No, I don't think he's right, because and the reason I don't think he's right is what money does is it looks for risk return. And guess what? If all the businesses go that route, then what you end up with is huge opportunities in other areas, in the fossil fuel areas. And I'll give you a very practical example of this. The Swedish government made a decision about 4 years ago that they're going to get out of coal. And they told their utility Vattenfall, get out of all your coal assets. And so what did that particular utility do? They said, okay, we're going to sell our lignite assets in Germany, the dirtiest fleet in Europe. Nobody would buy the assets. The assets were sold for zero. And actually they left €1 billion of cash on the balance sheet just to clean up the lignite plants at the end. And I can tell you that that particular buyer of that assets has taken €500 million in profit out every year since that. And now the German government has to pay that particular guy about €6 billion to close this plant down. Now, I say that as a really practical example. That's what clever money does. They look for the opportunity, and there will be opportunities as we decarbonize like that. That's what's going to happen more and more.
And it's a pretty extreme example. Rebecca, what's your view? Will companies be out of business in 10 years unless they wake up to the ESG reality?
I agree to some extent with Gerard, but I would also, in some regards, agree that the businesses just aren't going to get away any longer with not thinking about the broader impact that they're having on people and planet. I mentioned this kind of transition of capital moving from different generations, and those younger generations are looking for businesses to do better and to do better very quickly. I think the challenge comes in this point around overemphasis and no assurance of checking the claims that these businesses make. And so underlying that, it potentially real world outcomes aren't really changing, but there's this kind of marketing element that's going on because there is no checking that's happening.
Right.
And that's the challenge.
I'm in the very happy position where I've got a brilliant audience and brilliant speakers. And normally in a webinar, you're watching the number of people who are participating, and it starts tailing off after the first half hour, and it hasn't, which is a tremendous credit to yourself, to both of you. There's two lovely questions in from the panel, or from the audience generally, which I'd like just to raise with you. There's one other question on the operation of COP, which if you don't mind, I'm just going to park. But one for Jared to start off. You set out priorities early on in your talk, and one suggestion coming in is energy demand down, fossil fuels down, clean electricity up. Shouldn't that be the priority? Rather than...
Yeah, without a doubt, that is the priority. Absolutely. Okay. Without a doubt. Yeah. That's what we have to do.
Super. One for you, Rebecca. Again, very insightful question, I think, pointing out that a lot of fully remote companies out there, business models increasingly virtual, how can they commit to ESG and still make an impact if the whole direction of travel of the business is that way anyway?
Yeah, I mean, it's a great extra contribution. I mean, you can think in the amount of emissions that we would have had to generate, or we would have generated for this event, had I flown to Ireland and Gerard and everyone come into one space. So the virtual events are really creating a positive benefit. I mean, in terms of broader impact away from climate change, is in these companies that are virtual and running virtual events is ensuring that voices less heard are given a platform. So it's not the same individuals that are being heard across the same industries. It's getting a diverse set of speakers, voices, experiences, backgrounds. And I really think that that's where virtual events can create a better impact. And then as a result of that, you hear different experiences that might trigger different thinking in the way that listeners are acting. So slightly different approach to reducing emissions, because I think that one's quite hard to then address even further. There's not a huge amount more you can do there. But having said that, data providers are very, very big emitters. So there's kind of indirect emissions that these virtual events will be having to be cognizant of.
Yeah, and we're all very sensitized, I think, to that in Ireland, given the whole issue in relation to data centres and the strength of our own national grid. Another lovely comment in from one of our attendees, an extremely insightful session. Couldn't put it better myself. Rebecca from Gresham House, Gerard, Alexa Capital, you've made an enormous contribution to the debate, and thank you for your support for this webinar, your support for Chartered Accountants Ireland. I promised everybody at the top of the session that we would finish within the hour. It may well be lunchtime where you're sitting, I suspect it is.
Yes.
If it is, please go and enjoy your lunch and mull over what Rebecca and Gerard have shared with us. Please keep coming to Chartered Accountants Ireland webinars, because they're really good. You'll learn an awful lot. Again, my thanks to my colleagues Chris and to Susan for making it all happen. My name is Brian Keegan. I hope to see you again very shortly at one of our upcoming webinars. Thank you very much indeed for your time, your attention and your support. Have a good evening.